Welcome back to the Real Estate Talk Show. I'm your host, Jon Meyer, and hopefully you're enjoying another great weekend here in Cottage Country. And we're going to talk about an issue that came up in the news this week. Canada Mortgage and Housing Corporation is reportedly limiting guarantees that it offers banks and other lenders on mortgage-backed securities. The measure comes amid the federal government's efforts to protect taxpayers from risks in the housing sector. Joining me on the program to explain what this really means is Alyssa Richard, founder of Ratehub, which connects you to Canada's best mortgage rates. And you can go and find her online at Ratehub.ca. First of all, welcome to the program.
Hi, John. Thanks so much for having me.
This is quite the complex issue, and we brought you on to explain it for us. So I guess, first of all, a very broad question for you. What does CMHC's latest announcement really mean for the average Canadian, Alyssa?
I think to answer it properly, we have to separate Canadians into two groups. So there's taxpayers and then there's mortgage holders. So for the taxpayers, I think it's a good move as it limits our exposure to the Canadian housing market. You know, if mortgage defaults ever increase to the point where the CMHC ran out of funds, the Canadian taxpayer would be on the hook for the remainder. And now if we look at mortgage holders, we could see a couple of things happen. So first off, interest rates are very likely to go up. The program offered by the CMHC means that the banks can pool their mortgages on their balance sheets, and by adding CMHC's guarantee, they can sell these as a very attractive product to investors. So by limiting the CMHC guarantees offered on these, it means that it will get a lot more expensive for the banks to find funding for mortgages, and this increased expense will be passed on to home buyers in the form of higher interest rates.
My next question is, does this spell the start of higher mortgage rates? Obviously, you think so here in Canada. What type of increase are you expecting? I guess is Ratehub expecting? We've been kind of waiting for a push up, over the past couple of announcements. But what kind of sense or what kind of idea can you give our listeners as to how high up mortgage rates, in fact, will go here in Canada?
I was looking at some stats published by the National Bank analyst Peter Rutledge, suggested that we could see an increase of 20 to 65 basis points. And so, let's put that into English. 65 basis points means 0.65%. So I prepared a little example for listeners. So if we look at today, the lowest 5-year fixed is 3.19%. So if we looked at the most extreme end and analyzed the 65 basis point increase, 5-year rates would go from 3.19 up to 3.84. So then let's try to understand what that means from a payment perspective. Well, in July 2013, the average home price in Barrie was about $300,000. So this 65 basis point increase on that average home means an extra $100 a month, and over the full 5-year term, an increased approximately $5,500. It's also important to pause and just reflect at the last couple of months in Canada in the interest rates. Up until about June, we were seeing rates as low as 2.70%. So rates have already increased to 3.19, and this would be an additional 65 basis point increase. So comparing to pre-June 2013, it's a full 1% increase, and for home buyers, that could look like an extra $160 a month or $10,000 over a 5-year term. So pretty significant changes.
Yeah, when you add just an extra $100 to everybody's monthly payments, it does add up, especially with family and kids, and depending on how big your mortgage is. We're joined by Alyssa Richard, founder of Ratehub. Head to Ratehub.ca. She's joining us to talk about the latest announcement from Canada Mortgage and Housing Corporation, limiting guarantees it offers banks and other lenders on mortgage-backed securities. We brought her on to tell our listeners here in the Real Estate Talk Show just what that means. You'd mentioned the potential for that increase. Is that the start of what you see as a gradual increase?
It's a good question, and this is where we get into the more complicated economic analysis. I mean, the specific 20 to 65 basis points was the estimate assigned to, these specific limits on CMHC offering guarantees on the mortgage-backed securities. The earlier increase we saw in 2013, starting in about June, that was driven by the U.S.'s announcement to draw back the stimulus that they had been pumping into the economy. So I think that, talking about a gradual increase and further increase, that's really a different subject, because then we're talking about, what are our expectations on the European economy, the U.S. economy, and that's where my my expertise starts to end. But I definitely think, we can attribute 20 to 65 basis points to this specific announcement.
So who does this move by CMHC impact the most?
We've mentioned a couple. So, great thing for taxpayers. It shields them from the residential housing market. Home buyers are likely to see interest rates go up, and the impact of that is a bit difficult to analyze. Obviously higher rates means higher payments, but then you could also argue that these rates were being artificially held down by government programs, and the lower rates could have been inflating housing prices. So depending on where rates level off, if house prices did come down as a result, that could make things more affordable for people. And then I think the last thing that's important to point out is it definitely affects the larger financial institutions over, for example, the smaller credit unions. And this is because when you look at the limit of the $350 million per month, that's available per each institution. And so the banks who do significant mortgage volume, they're much more likely to actually hit this limit. And I pulled a really simple example looking at one of the credit unions, Duca Financial. So they're one of the biggest 5 credit unions in Ontario. And in 2012, their total mortgages on their books, they did 450 mortgages for a total of less than $100 million in funding. So it's really quickly you can see that the $350 million per month won't limit, the smaller lender, and maybe they weren't even participating in the mortgage-backed securities program in the first place. The banks, on the other hand, they are going to come up against those limits, and that's where we'll see interest rates increase.
Interesting. Alyssa Richard, founder of Ratehub, joins us. Just a couple more questions for you. We're running out of time here, but we do appreciate you taking time out of your busy day. I know you've fielded a lot of calls from media over since this recent announcement came out. I'm curious as to what some of your customers for Ratehub are asking you guys a lot of questions about this latest change. Have you guys been very busy in your office since the latest announcement?
Yeah, it's always incredibly busy, and whenever the CMHC or the government comes out with an announcement like this, I think this one maybe was especially busy because people really wanted to understand what these mortgage-backed security products were. And, most people, when they hear CMHC insurance, they think of, this is the insurance I have to buy if I put less than 20% down. Mm-hmm. And so since this was a different type of CMHC insurance, we really wanted our users to, understand what exactly was going on.
Again, we're joined by Alyssa Richard, founder of Ratehub. Visit her online at Ratehub.ca. Why was there a need for further intervention from Ottawa in the first place?
Well, I think this latest move was an attempt, firstly, to cool the market, and then secondly, limit the government's exposure to the housing market. So, the government has taken many measures in the past to cool the housing market, and I'll give you an example of one. So, just last year, they reduced the maximum mortgage amortization to 25 years. But despite some of these changes, housing continues to thrive, and this is especially true in major cities like Toronto and Vancouver, and this is where a lot of the government's concern is concentrated. So, as an example, just last week, home sales were up more than 16% in Toronto in July when compared year over year, and increases were reported in most major Canadian cities. And in addition to sales being up, Toronto prices were up 8% in that same period to an average of $513,000. And I think one of the other major concerns to regulators is the new condo construction boom in Toronto. So pulled some numbers on that, and there are currently 55,000 units now under construction across the GTA, and another 30,000 condos in the pre-construction phase. And more than 18,000 of all those units remain unsold. And this is a number which has been climbing, according to Urbanation.
For those who are curious to find out more and want to talk to you or some people with your team, what's the easiest way to do that? Go online or to give you a call?
Yeah, to head to our website, and there they can use our contact forms. They can call us directly. They can participate in any of our blog articles. Going to the website, it's really easy to contact us through Twitter, Facebook. We're everywhere. Alyssa
Richard, founder of Ratehub, thanks very much for doing this, and we'll chat soon.
Great. Thanks so much, and have a great day, John.
We're back with more here on the Real Estate Talk Show. Coming up next, we're going to talk to Andrew McKay with another edition of Ask the Expert.